So, good afternoon, everybody. I'm really pleased to have all of you here. And for those of you who are following via the internet, via streaming, very warm welcome to you as well, wherever you are. So, before I jump into the section, which is about cost and portfolio transformation, it would be really a shame and a pity not to talk a minute about 2014. So give me just 2 minutes, talk a little bit about 2014, and then I'll come back to the real stuff here in terms of the cost and portfolio transformation. So I'm going to start with a 2014 perspective, and I start on the right-hand side, on the full year's perspective. Tim mentioned that already. I think the key messages you should remember, you should have in mind are the following. Number one, we are a growing company again. It's a 4.2% growth. If you look at an organic view, it's a 2.9, so there's a difference in there, obviously, but clear message, there is growth, number one. Number two is, and that is how it should be, we delivered what we promised in terms of the EBITDA, in terms of the free cash flow, and also in terms of the cash capex, so the money we invested into our future. So basically, no surprise. You know that from my side, I'd like to be a very reliable, or some might even say boring guy, just delivering what we're saying here. So I think that's what you should remember on the full year, and I come back to the balance sheet in a minute, so I skip the net debt side of that right-hand side. But I like to have a close look again on Q4, because what you see there is that some of the very important trends, meaning the revenue on one hand side, the EBITDA on the other hand side, and also net profit, you see strong improvements. I can tell you I've been with the company since '92, and the last time I've seen that kind of development is like late 90s, which was a fun time, It was like party time, and that feels like this plus around 10-ish in terms of revenue growth and also EBITDA growth we've seen here in Q4. So I really like it, and like to remember you that this is not only, it's by a huge extent, it is coming from the US, but not only, and that's the good news, there's also Germany behind on the revenue side. There's a huge cost reduction and efforts on the European side supporting that, et cetera, et cetera. So I think looking at Q4, very much supporting numbers, especially looking at the guidance for 15 Tim has given a minute ago. I said it already, it was just a very short view on 14, but what I want to do as well is have a short look at the balance sheet for 14. And I said already, on the net debt, the page before, and there was one of the two figures you might have some concerns about, and let me address that. What happens on the net debt, and you know that there is an impact of 1.8 billion roughly in dollars to euro exchange rate in the net debt, increasing the net debt. In parallel, on the EBITDA numbers you have seen here on the right-hand side, on the EBITDA for the full year, the FX effect, so dollar and pounds and whatever we have here in terms of exchange rates are a wash across the year. So the EBITDA impact of exchange rates across the whole year is minus 3 million. So no change basically by exchange rates in the full year EBITDA. That is because, for instance, in the beginning of the year, the dollar was weak and then it strengthened across the year. Same for other currencies. So EBITDA was not impacted, so to say, on the exchange rates other than the net debt, because we're looking at the end of the year and then taking the dollar course. So obviously there is a 1.8 billion impact here on the net debt we need to take into account. Nevertheless, you see the net debt to adjusted EBITDA and all the other ratios we have here, according to the balance sheet ratios we want to have, are in our target lines. We have the green lights being in our comfort zones, and the same holds true if you look at the big rating agencies. You see there is a stable outlook looking forward. So that was the minimum I wanted to do at least for 2014, and let me now move forward to the cost and the portfolio perspective, which is the key part of my presentation. I think what I want to tell you here is, in the first instance, and I think Tim was crystal clear on that, it is about differentiation. We need to give and find reasons for the customers to choose our products and pay more. There needs to be important reasons for the customers to do so. So basically, that only is possible if you do two things. You need to differentiate, and we've been quite clear where we want to differentiate. It's network, quality, and consistent experience, and it's the customer experience. Those both areas, we want to outperform the rest of the pack and clearly differentiate. Okay, so that's one element, and the other element is, in parallel, in the meantime, we want to transform the company in a way, I come back to that later on the superior production model, in a way that we even strengthen that differentiation over time and even get a bigger distance to the competitors in terms of what they offer. And if you want to do so, you need to put investments in place to make it happen. For network, for customer experience, for simplification of the products and the processes, and so on and so on. And you all know, and I've been part of that for several years, the good old story of telcos is, okay, we're going to invest the first 2-3 years, and then afterwards everything will be fine. I've been part of that several times, and believe me, I know that very often after 2 or 3 years, there's the next story and the next story and the next story. And what we don't want to do is change that. The way we want to tackle it is as follows. We want to change by differentiation and by transformation, put the investments in, and in parallel, at the same time, continuously grow revenues, EBITDA, and free cash flow. That is what you have seen in our guidance on the midterm perspective, what you've seen in 2015, and that's basically the story I will talk about now. And it is about, as you can see here, number one is we have a cost gap out of our benchmarking activities. We know roughly our cost gap is around 2.4 billion. I come back to that in a minute. We will close 75% of that in the next 4 years, which does simply mean we will reduce our indirect cost ex-US, and I will mention that in a minute why that is ex-US, by 1.8 billion. So that is for 15 to 18. That is what you will see in the reported numbers as a net effect, incorporating all the investments we have for transformation. In parallel, we're doing that kind of transformation. And after that period of time, by the early 20s, we will see huge changes in the OpEx line by that transformation, by another 1.2 billion of OpEx saving. Tim mentioned that again also. And additionally, portfolio management will simply have an ongoing focus on supporting the strategy and the value creation. So now, let's dig a little bit deeper into the cost transformation, what we're going to do there, what you can expect, and what you should see along the timeline in terms of changes we're going to do. First of all, I mentioned it already. US is not part of that here because, very simple, I think US is in a different stage. US is fast growing. The US team has shown that they are very, very cost conscious, that they are not only looking at the marketplace, but also taking all the costs out of the operations which are not of relevance for the customer or for the competitiveness of their company. But again, fast growing, different market situations. So that's the reason why we're here, only looking at the ex-US, so to say, DT perspective. And the cost gap as of 2014, as we've seen it, is 2.4 billion euros here, and we're going to tackle 1.8 of them within the next 4 years. I've given you the split here also on the left-hand side. The biggest and most challenging element, I think, in terms of that closing that gap is IT. You know, why is that? And I'm always getting enthusiastic talking about the IT side because it is not only about cost. If you have high IT cost in an incumbent process and IT infrastructure, it does simply mean you are by far too complex and you missed simplification. Or the other way around, if we drive towards simplification, if we make it easier for our customers to use and provision our products, if we give the control basically to the customer, you will see IT costs falling like hell. So the IT costs and the gap is simply, from my point of view, nothing else than a proxy for a lack of simplification. That's where nicely two elements come together, cost reduction on one hand, but on the other hand, an upside in the marketplace. So IT is the biggest chunk, but as you can see here, I don't read them all. The other areas are of importance as well. And we're going to tackle that 1.8. That's what you will see in the reported numbers. Okay. Tim mentioned that already. Our thought process behind is what we need to do is get the share of the indirect costs down, because basically what will happen is, as you can see here, if you move it down from, let's say, beginning of that decade, like 2/3 of the OPEX being indirect cost, to 10 years later, 50% being indirect cost, what you're basically doing is you're de-risking, because the direct costs, they don't cause too much trouble from my point of view, because they're strongly linked with the revenues. Either the revenue kicks in, and then you have a nice margin out of it, or the revenue doesn't kick in, so you don't have the OPEX. So on the direct side, there is a variable element of the cost. It is not on the indirect side. So we want to change that step by step, that mix, and de-risk, so to say, also here by changing the share and moving the share of direct costs up versus the indirect costs. And it is clear to do so. We will, again, like you know that from the past, we're using special factors. We're using money to get people into early retirement, to get them off the payroll, et cetera, et cetera. And you've seen 2013, a relatively high level of that restructuring expenses. In 2014, it was a relatively low level. That will increase again on 2015, as you see here, by 30%, especially because we will see extra activity in the German geography on restructuring. We've announced that 12 months ago when we talked about the restructuring of T-Systems. The market unit is a major share of that one, but also especially headquarter functions here in the group headquarters, but also in the German environment. So that is the reason why that will increase again. And as you see the line here, we've shown that will slow down again on 2016 and go a little bit up on 2017 again. Because the basic idea is you go into the organization, you take headcount out, you need to let the organization settle by a certain distinct, and then you go again. That's basically how we do it in the German geography, and that's why you have that kind of profile, time-wise. Okay, so how are we going to do it? Basically, we started some months ago, first of all, with the programs we had already in place. We had several programs in place in the German environment. In Europe, Claudia is going for a program called 1DT Europe. We mentioned last year the restructuring in the T-Systems environment. We changed the way, because we adapted our strategy towards partnering, the way we deal with the innovation center, the DBU next, as we call it. So that was all up and running already. Programs not all preliminary looking at reduction of cost, but at least with a relevant cost reduction impact. And we just screened what we've missed so far, taking those programs which are already in place, and then looking what have we missed, and basically we came up with the 3 elements you see on the right-hand side. It's further reduction in headquarters, where you don't have any impact to network or to customers and steering functions. It's the whole area of shared services, where we think, and I come back to that in a minute, can do much better. And it's about a logic we call target costing approach, and I will talk you a little bit through later on what this is about and what you can and what you should expect here. Okay, so before I go into some examples and make you a little bit more comfortable with what is behind, I want to give you the split across the segments of what you can expect as a net indirect OPEX reduction, because I said that is what you should see in the numbers afterwards, and then it's I think good to make you aware about where will that occur in terms of the segments, and you see here the split, which is more or less representing also the split of gaps we have in the group. There is one element which might look a little bit funny, like minus 0.1 in the headquarters. There is some consolidation in there as well. So the headquarters are on a track to reduce at least by minus 4% net year by year. That's their minimum track. There is more in the headquarters than 100 million, but there is also consolidation effects within the group. So one being a service center for another one. And then you see, for instance, in Germany, you see reduction because the headquarter is serving with some services the Germans cheaper, so you see the savings here, you don't see them here. So that's the reason why on the right-hand side the headquarter might look a little bit funny. Okay, so basically minus 1.8 billion, that is the split on the segments. And let me show you some examples of how that cost reduction will work in terms of content, what are the main areas we're doing it, and how we're going to do that. So let me start with the personal efficiency. That is very much related to the German geography. You've seen during the course of 2014, I think especially if we talk about Q2 and Q3, figures, EBITDA figures in Europe, you've seen that Claudia is already very aggressively going after headcount reduction and cost reduction in Europe. Tim mentioned that, minus 500 million of revenues, minus 40 million of EBITDA. There was a very high level of discipline on the cost side here. We think on the German side, German geography, we should do more, we can do more, we have to do more, and that is basically what you see here. That is related to Germany in the overhead element, so the segment Germany overhead. So all the people who are not directly dealing with the customer or with the network or being involved in the transformation, all those are called overhead. It's not only finance and HR, it's also marketing, people doing analytics, etc., etc. So everybody who's not touching network or dealing with customers is meant with that overhead. So roughly 20% reduction there. On the right-hand side, as an example, Vivento on the headquarters side, nearly 50% reduction. And obviously, as we have announced, a further reduction on the market unit on T-System side as well. Just a few examples, that is roughly 500 million you should expect here. Another example is shared services. I mentioned that. What we've done so far is you see shared services activities across DT, but you see it per function, per country. So there is an HR shared service in Germany. There's another one in some European countries. There's one in Germany on the procurement side, and there's another one in other European countries. What we haven't done so far is combining the classical functions of shared services, like you see them here, HR, accounting, procurement, and reporting, dealing with them in a way that we create a target picture. End of 2018, we're going to have a European shared, multi-shared service footprint, changing the way we deal with it in an end-to-end process perspective. So not the accounting guys are doing their stuff and the procurement guys are doing their stuff, but dealing with the whole value chain in an integrated way. And we do know from externals doing that, and we know from our internal analysis that at least we will see 150 million decrease of the costs and the OPEX here till 2018 on that one. And as you see on the chart mentioned below that bars here, that is not the end, because we think after 2018 towards 2020 there is more to come, more we can get out there. So multi-shared service as another example. A third very important example from our point of view is Tel IT. You know, 2011 we said clearly we're going to reduce IT spend by 1 billion, and that's just related to the German geography again. It's not Europe, it's not US, it's just the German geography. And we said we're going to reduce it by 1 billion from 2011 till 2015. That was our commitment at that time. Current status is we've reduced it from 2.8 to 2 billion, so roughly 800 million. I think we are on a very good track towards that billion in 2015, but there's a clear message, there needs to be more. And I mentioned that in the beginning, this is not only about cost, this is much more about simplification of the way we deal with the customer, of our processes, of our infrastructure. And again, if you want to give customer control, much more control, your processes, your IT has to be much simpler, much easier, and then also the costs will go down. So that is on Tel IT as another example. And where I'm really energized about is the whole thing about target costing. You know, we did that, a bigger approach, first time after last Capital Markets Days. It was December 2012 when we told you guys that we're going to heavily, if we got the allowance of vectoring, what we got then finally from the regulator, that we will heavily invest in vectoring infrastructure. And we said at that time, we guess we will need roughly 300 euro per household to make that infrastructure happen. And right after the Capital Markets Days, when it was over, I've had a chat with Bruno, basically. Talking about Bruno, I think we need to find a way to get the same output with 1 billion less. And he said, it's a good idea. By the way, that's not the normal reaction of a CTO, you know. And he said, yeah, let's try it. Let's give it a try. And then we put 20, 30, 40, I don't know how many people together in a room, and they've been there for several weeks and thought about what can we do completely differently to make the same output happen with $1 billion less, or basically on a level of 220 per household, which is the same kind of logic. And they came up with a whole bunch of ideas, tons of ideas. The way we do the rollout was changed in a way that you get money out of that, you get efficiency out of that. The way we used the existing fiber infrastructure was changed, and the way we did the planning was changed. So it was quite amazing to see that the people started, you know, at the beginning when we said, very simple equation is get $1 billion out and the same output. They said, okay, I want to have the same. You're smoking, you're completely crazy, we can't do it. And after several weeks of just doing it, trying it, finding ideas and elaborating on those ideas, basically the outcome, and you see that the actuals in 2014 now is per household 220 and not 300 anymore. And similar, little bit similar on the NGTV platform. You know, our current cost, as you can see here on the platform, is roughly 110 million. And what we did is we sat together with the marketing guys and asked them, what do you think, knowing that there is Netflix, there's OTT players in the market, there is a change in behavior of consuming television, you know? It's, like my age is very often using the classical way of linear television, but my kids, you know, they use other channels to get their television content. So in that world, how much willingness to pay will be available from customers' point of view to justify cost of a platform? And then we had a debate, the technical guys, the IT guys, with the marketing guys, to find out what is it basically per customer, how many customers, et cetera, et cetera. And our conclusion was we cannot allow higher cost level than 60, 65 million for the platform. Basically, that was the starting point when we set the teams together and said, okay, you need to come up with 65, find a solution. And it took them some weeks, some months with the right supplier, with some ideas from the supplier side as well, some things we haven't seen before in terms of our thinking. And we changed the way, we defeatured some topics, some features where we thought that will not be of relevance for the customer later on, et cetera, came up with that kind of solution. And that is an approach we're going to apply consistently across the whole group. The next one pilot is running right now is in Europe. You see it on the right-hand side. It's the whole area of provisioning and fault repair and fixed line. If you take the OpEx altogether in the European segment across all the fixed line operators, and you take the cost, the OpEx of those processes, it's roughly €1 billion ticket. We're now going aggressively after, because I can tell you the target cost for a complaint and a fault of a customer in fixed line, you know what it is? You don't need a marketing guy to answer that question. It's zero. The customer don't want to have an issue. They want to have a zero default, zero defect infrastructure. And you know, there's always a little bit, but you know, it is a very simple equation here. We need to get rid of all those types of activities we call service, but no customer wants to have it. So that is an exercise again we're going to do here, and it just should give you some idea what our thinking here behind is and how we're going after it. I think we can be very self-confident that we're going to get to that point, because that was what we have promised to you last Capital Market Days on the cost side, and then the Capital Market Days 2012. I don't go through all that, but you see there is one green light on it. I think we have delivered on what we have promised here as well. And that picture should give you now, especially if you want to do some modeling, if you're not sure whether you got it right, should give you the clear message what you should expect and what not in terms of the OpEx development. So if you look at the left-hand side, what we did is we split it in gray the US, because as I mentioned, different story. And looking at the US here, you see some CAGRs, but you know the revenue and the EBITDA CAGRs are by far above that, so not an issue at all. So let's concentrate on the magenta areas. You know, you see 2014 adjusted OpEx, that is direct costs, so the cost directly related to revenue. So whenever you do termination, you pay something, or whenever you do roaming, you pay something, etc. So those are the direct costs, the costs linked to the revenues, and you see the indirect cost. Indirect cost will be net reduction by minus 1.8 billion. You see on the direct cost, there's a CAGR of 1 to 2%. Why is that? Because ex-US, there's revenue growth as well. And with higher revenues, you will see a little bit higher of direct costs. Should not raise any concern because there's a good margin baked in there. Nevertheless, there are two elements to mention here on the direct cost. One is the revenue growth per se, and the other one is naturally that losing €1 of revenue in single play and voice fixed line telephony obviously is in terms of having a very high margin in that compared to getting a new euro of revenue in. You will have a lower margin in there. You will have also kind of mix effect. So that is why you see on the direct cost a CAGR of 1 to 2%. And as I said, the net reduction of minus 1.8 on the indirect cost reduction. If you do the math, 10 billion roughly on direct costs, CAGR 1 to 2% on the direct cost. It is something between 400 and 800 million. You deduct it from the 1.8. You will see at least $1 billion or $1.5 billion. That's the kind of vicinity you will have on the adjusted OPEX. If we see growth in revenues, what we think will happen. Okay, so I think that's the basic way to put it. And that is for 15 to 18. That is what we're going to do from 15 to 18 and what you can expect from 15 to 18. And as Tim mentioned, in parallel, we're doing that. We're going to transform the complete infrastructure. And obviously, there are costs related to that. I will show you the graph in a minute. There are costs related to that transformation. And those costs are in the numbers you've seen before, a minute before. So what we're basically doing here is 4 key elements. One is we digitalize the customer-facing processes. Number 2 is the all-IP transformation. We're going to make sure the infrastructure elements, they all speak the same language. They all speak IP, technically. Number 3 is we will move from a multinational operation. Each and every country is operating their networks by its own into a pan-European operations and virtualize the network. That is basically what is behind 3, a very powerful element. And number 4 is have the best access and the best connectivity for our customers. I'm always, completely enthusiastic about the number 1. Because, yes, there is OPEX savings of 1.2 billion, I'll come back to that in a minute, behind it. And for a CFO, OPEX reduction is always a good thing. But I can tell you the most powerful element is number 1 in that one. Because making it easier for the customer to use our products, giving the customer control, what he or she wants to use and what not to use. Eliminating barriers for usage we have created today, that's a huge upside we might see. And I don't want to go too much there because I know Claudia later on will elaborate on that one very much. But I think that's the most powerful part. Nevertheless, there's also fun in there for the CFO, which is on the right-hand side. The annual run rate on the adjusted OPEX savings from the early 20s onwards will be 1.2 billion. So I've talked about the minus 1.8 in the indirect cost savings, 15 to 18. While we're transforming, you will see that net effect. And then out of that transformation, later on, you will see additionally that 1.2 billion in a later stage. So that's the way how to read it and to get it hopefully right. And what I also will want to do is give you a little bit more insight on what is the investments we're putting right now for 15 to 18 in there, and what are the areas where you should expect that 1.2 billion are coming from. And again, here, Claudia will talk a little bit more later on that split. First of all, on the upper left-hand side, you see that graph. That graph is showing you remember, 1, 2, 3, digitalization of customer-facing products, all IP migration, and the pan-European part. That is what is behind the upper graph on OPEX and CAPEX. That's what we're putting in. And you see in 2014, it was 800 million of investments to make that happen. That will increase further in 15 and 16, again, all in the numbers you have seen, to roughly 1 billion in 16, around 1 billion, maybe a little bit more, maybe a little bit less. And by the way, also for your modeling, maybe important and helpful, in the early stage of that graph, it's very high level of CapEx in there because you change something in the network. The OpEx part and share in, for instance, in 14 is, or in 13 as well, is between a quarter and a third. Moving to 16, that OpEx share increases significantly to roughly 50% because the more you go along the timeline, the more you have activities like switching in the network, like customer service, which is much more OpEx loaded. And on the bottom side, you see that share of the CapEx we're putting from the European and the German CapEx, the total CapEx, into the improvements of our last mile of the access, the so-called integrated network strategy net. Okay, on the right-hand side, a little bit about the split of the 1.2 billion I mentioned. Basically, you see here two types of splits. One is geographically. What is Germany, what is Europe? By the way, Germany is also Europe, but geographically, but splitting into our segments. Germany is around 700 million, Europe is around 500 million, and in both parts, in Germany and in Europe, there is roughly a 200 million ticket on the technology side, and there's roughly a 500 million in Germany on the service side and a 300 in Europe. As I said again, Claudio will come back to that and elaborate a little bit more about that one. So before I move to the portfolio part now, let me summarize again what you should expect and what not. What you should expect is, if you look at the OpEx of Deutsche Telekom, differentiate between the huge growth story in the US and the rest of the DT. On the rest of DT, you will see on the indirect side, indirect OpEx, you will see a minus 1.8 billion. You will see a slight increase on the direct OpEx if the revenue growth kicks in. If not, obviously not. But this is the plan, and you will see at least a billion to $1.5 billion of net reduction in the overall OpEx bar I've shown you. That all incorporates the investment we're doing here to transform as fast as we can. And that transformation will lead to another 1.2 billion of OpEx reduction after the planning cycle and period I mentioned. So now to the portfolio transformation. Tim mentioned that already. I think we can be proud of what we've seen during the course of the last years. That was not always the case at DT. I mentioned I've been with DT for more than 20 years, and we had some dark hours as well in terms of M&A. I think at least looking at the last 6-7 years, that's not true anymore. We have an excellent track record here. And I want to talk a little bit about that track record in 3 buckets, basically. Growing values of assets, and I'm not going to talk so much about the TMobile US because John will do that tomorrow in his session, but also looking at TMobile UK. Remember, end of last decade, it was a number 4, difficult number 4 spot on mobile only we've been in, where we're now. On number 2, on the sale of non-core assets, I think we've shown that we can do smart deals and smart moves because the sales we have done on Global and in Scout as well, compared to the market, I think we've outperformed with the multiples we've shown here. On the same holds true on acquisitions. If you look at Poland, if you look at Czech, and also if you look at Metro. And by the way, although knowing that John will come back to that one, sorry, John, I take that one beforehand, I think it's not only the question what kind of multiple you show here. There is one even more important question, which is how you execute on your synergies and on the whether you make the synergies happen or whether it's just a nice business case you have the moment you buy an asset and then you see somehow the synergies disappearing. And I think the US team has done a tremendous job on integrating Metro PCS in the best way you can do it. You know, the original case was, I think it was 6 to 7 billion on synergies on Metro. We are now talking about 9 to 10. John will come back to that tomorrow. That is how you should do it. Not only pay for a good price, but then ruthless execution, do it the right way, and make sure that the synergies you have in your case are being delivered or even over-exceeded. And yeah, I think we can, as DT, be proud of what we've seen here. We have that strong track record. Tim was already mentioning the de-risking, self-funding, and kingmaker asset strategy, and as I said, John will come back to that tomorrow, so I'm going to skip that here also for the sake of time. But I want to spend a little bit of time on that chart because that will be not part of Claudia's presentation, which is the de-risking story at OTE. Greek not being the easiest geographics to be in, and believe me, for Claudia, for the whole European management team, for Michael Samash, our CEO in Greek, it was tough times last years. But what they have done, I think, is really worthwhile to mention. Is phenomenal. You know, they sustainably deleveraged in the first instance the OTE by selling Telekom Serbia, Global, Hellas-Sat. And look that the cash flow generation is an appropriate manner. With that, you see on the right-hand side, the rating improved by Moody's. We're covering the maturities of the next 3 years till 2018 with the cash we have in the company, OTE. And the leverage is now on 0.8, as you see on the bottom right-hand side. So I think in that difficult environment, to generate and deliver that story, and in parallel, not completely losing the market, but further differentiating versus competition, further investing, further being attractive into the customer, being number one in customer's choice, that's a real story which needs to be mentioned. So all the congratulations, Claudia, to yourself and the team. I think it's a great story here on the de-risking on OTE. And it was mentioned already also EE and BT. I don't want to repeat all that stuff here. You see it on the chart, and Tim mentioned that already also a minute ago. I think, you know, we firmly believe that for Europe, a model where you have fixed line and mobile, where you've been the number one in B2C and B2B operations, and where you get the synergies out of that fixed mobile convergence setup. And synergies, by the way, does not mean discount your products. It does mean you get synergies out in the infrastructure, you get synergies out in your IT, you got also synergies out by a higher level of attractiveness to the customer. That kind of target picture is in our mind. This is where we're heading for from our strategy, and that's exactly what happened from the late end of the last decade with a number 4 player in mobile only, now to the new market leader in a combined fashion and setup. And I want to repeat what Tim said already on our portfolio and in our M&A policy. In Europe, selective and minor FMC and ICT acquisitions in our core integrated countries, like you have seen it with GTS, sorry. That makes a whole lot of sense. TMA and TMNL being on a mobile attacker strategy. US unchanged. We will always look after smaller technology M&A activities. You know, our thought is, part of the partnering thought in the strategy is, let's look who's the best owner for something. And if we find the best owner, let's make it easy for our customer to access that owner. And the same should hold true, by the way, in technology, looking at some M&A steps. On the minority shareholder side, I very often get the discussion when we will buy out Slovakia or this or that. You know, that's not the way we're looking at it. The way we're looking at it is if there is a business case, if it does make sense, like it did in the Czech situation, where we've been able to buy out the minorities to avoid dividend leakage, and we had a good case, we're going to do so. But to make our pan-European network happen, to deliver on that one, there is no need for action from our side. And the general policy, I'd like to repeat it again. Tim said it already, but I think we should repeat it again and again and again to avoid misunderstanding, is no major acquisition outside our footprint. So that's basically what the cost and the portfolio transformation is about. I try to be fast and make up the time. I'm done. Thanks, guys, for your attention.